exposing the secret sauce in business-to-business marketing. The TAGLine Podcast is where real stories meet proven strategies. Let's elevate your business. Real strategies, real stories, real results. In the business-to-business industry, you're not selling to businesses. It's human to human. We break down what works, what doesn't, and how you can truly stand out. Transparency, credibility, growth. Get a behind-the-scenes look at what drives success in business-to-business marketing. Get ready for the next TAGLine Podcast powered by the Aebli Group.
Welcome back to the TAGLine Podcast. My name is Justin Starbird, and today we are welcoming a special guest, CJ Connell, to the show today. He is the editor of The Shack, Media Hub, and the Heritage Project. CJ, great to meet you. Great to have you on this morning.
Thank you. Thank you very much. Great to meet you. It's coast to coast communication almost. I know it's close to the coast over here.
It's great to, we've talked a lot offline about, what you've done, your career, and a little bit about some of the inspiration that you had to start your newsletter. Talk a little bit about, early part of your career and how you got to be introduced to crowdfunding.
Well, I went into the financial business, estate planning, back in 1987 when the market crashed. I was in the landscape maintenance business, and I can remember sitting in my truck listening to the market crash, and I can remember clearly saying to myself, I might have even said it out loud, I want to be in that business. And by the next May, I was in the business, and I was learning the basics of estate planning and financial planning. And then I went on and became a stockbroker, and was with Morgan. It ended my career when I was with Morgan Stanley. I retired early in 2007, right before the major crash, knowing it was coming and wanted to have more fun in my life, and moved to my home in Lake Tahoe, bought big video cameras and started filming rock concerts and reggae concerts with, and I don't mean from the audience, I mean from the stage. I got connected with the promoter, and it was a lot of fun.
Yeah.
So that
sounds like a lot more fun than a stock market crash.
It was a lot more fun, a lot less money.
Yeah.
So I worked in estate planning, and then I got into the 401k business, and I specialized in 401k very early on, and built that business pretty much. Enjoyed it, but it became very commoditized. Sure. And I liked it when it was on the frontier and we were pioneering new things. I didn't care for it so much when everybody and their brother in the business was getting into it and thought they were experts. And it got diluted and, like I say, commoditized. It's everybody where. So I worked a lot with small business owners, and the challenge that I had and the realization I was coming to, everybody has good hindsight, but when you're in the midst of it, you don't understand what's going on. And I was having a problem because my prospects and my clients were facing, one of them, George's Plus Shapiro, a printing company in Sacramento, said to me, we're faced with either they were in California, we either grow or go. And they sold out. And that's what was happening to everybody. Everybody was getting bought up by the big corporate umbrellas that exist out there. And I didn't want to work for big corporate umbrellas. I like working with small independent businesses, the private equity market. So when that was going away, I laughed. I said, I said a lot of things. I won't repeat them here. But that was my background, and my impetus has always been small business. I have a degree in agriculture. I'm really interested in small farms. I'm not interested in big farms.
Yeah.
So that was the background. So when crowdfunding came around, it was like, well, this is the solution, because a lot of people don't understand. If I could go into a little bit of the history. that our security laws are based on the 1933 and 1934 Security Acts. There's two of them, they're sister acts, okay? So they created the system that still exists today, and crowdfunding regulations are actually exemptions to those laws. It expanded the exemptions. So those laws still exist, but now we have some exemptions that allow things to be done by regular retail investors. Because what the 33 and 34 Act did was it created this concept of the accredited investor. You're familiar with it,
Yep.
Of course, but maybe I could just point out the accredited investor. It's a longer story than this, but basically you got to be a millionaire. So it created this concept that people with money could invest aggressively and often and into the private equity market. But the people that were retail investors, non-accredited investors, they weren't even allowed to know that companies were raising money. They couldn't be solicited because there was what's called the prohibition against general solicitation. So that over time, based on the 33 and 34 Act, that became, you can't advertise. You can't tell people about it. If you're not an accredited investor, you can't solicit them. So they're limited in, there's some narrow corridors that allow non-accredited investors to invest in private equity, but they're very narrow. And I saw Tony Robbins in an interview, and he pointed out, Tony Robbins, the motivation speaker, and he's very much behind this concept. I don't know that he's behind the crowdfunding specifically, but he's really behind the idea that we need to create an ownership mentality, even for employees, because you can, under the new laws, you can be an active participant in the financing of businesses. If they go through the crowdfunding regulations. But that law, that accredited investor component, I believe really damaged our economy because it created the super wealthy and the bifurcation in our society. And when crowdfunding came along, it was like, well, this is a window at least being opened to the opportunity that enabled non-accredited investors to participate in private offerings to a limited extent. There's regulations that limit how much private investors can invest based on their personal income and personal net worth. But the minimum is, I believe, $2,500, even if they don't have income. Otherwise, there's a formula that takes into account and enables them to increase that annual $2,500 amount.
Sure.
And that's good. I think the limits can be elevated, but there needs to be limits. I mean, you don't want somebody saying, I'm going to put all grandma's nest egg into this go-go startup and then have nothing left for grandma.
Right.
So you need those limits. And you need regulations because you need to maintain the integrity of the market. So that really got me excited. And when it was initially introduced to the country, as far as the regulations from the SEC, so it's the 2012 Jobs Act. And then in 2016, it was introduced. Here's the regulations. It took them 4 years to come out with it.
Took so long if it was such an exciting,
I don't think the SEC or the big banks or the Vulture venture capitalists wanted it to succeed. So they really, in my opinion, designed a system that was going to fail. And in 2016 till 2021, it was doing a good job failing. So in 2021,
in your opinion, why was it doing a good job failing?
There were so many restrictions that the small businesses, they could only raise $1 million. Now you can raise, so there's two different types. So I'm talking about regulation crowdfunding, which is authorized under Title III of the Jobs Act of 2012. So there's another component called Regulation A+. So, but for discussion purposes at this point, you could raise only $1 million under regulation crowdfunding.
Yeah.
Well, your clients know, raising $1 million, the work necessary to raise $1 million is the same amount of work raise $5 million.
Right.
It was just onerous. It wasn't effective, and $1 million was just too low of a floor. So in 2021, and also there was a lot of restrictions and confusion about how companies could advertise. So they couldn't reach the public. The only way that you could really advertise was if you were only letting the accredited investors. That there was some exemptions to the prohibition against general solicitation. You could advertise, but only accredited investors could invest. So it really wasn't effective, and it wasn't reaching the masses. And in 2021, a new set of security exchange regulations went into place that elevated that to 5 million. Regulation A plus can actually go all the way up to 75 million. And that's in a 12-month period, not a calendar year, a 12-month period, which means for a company that's growing, you can raise another 5 million the next 12 months.
Yeah.
And then if you get large objectives, you can switch to Regulation A plus, which is more onerous to qualify for, but can elevate your opportunity to raise up to 75 million. And a company called Newsmax, many people know of Newsmax, actually used it last year to go public. And they raised the $75 million, and actually it was a backdoor into being a public company. Am I keeping it concise?
Yeah,
enough?
that was great. That was great. I think you've taken 14 years worth of information and government waste in terms of getting it out there, and you broke it down in about 8 minutes. That was awesome.
And without any expletives.
Yeah. What made you want? I mean, you seem to have always kind of been at the forefront of where some trends are going, and it's taken as we're talking about 14 years for it to actually really start to have a significant imprint on what investors can do, and given those founders, small businesses, an opportunity to grow the business, to scale, to bring a product to market. What made you personally want to get more involved on this side of things?
I really see it as a return to free market capitalism, at least in the direction. Everything's on a scale. You don't get complete, but it's a scale. You don't want complete. And it's a return to it. It's bringing the opportunity back to Americans that has been closed since the Great Depression, when the security laws went into place in 1933 and 1934. They created that accredited investor regulation that has hindered our society and bifurcated it between the super wealthy and the rest of us. Yeah. And so I saw it as something that just hit my heart. That was my goal. I put myself through college with my own business. I've always been an independent. I was 16 years old painting the neighborhood homes. I was always an independent guy. I like working for myself more than in a company. So that was kind of more my foundation. And when I got into the financial business, I gravitated towards venture capital. And I was in Sacramento. I ended up being the chairman of an organization called Access Capital, and we put on these big venture conferences that were similar to Shark Tank, but it was long before Shark Tank. And we would put them on in Sacramento, in Tahoe, Squaw Valley. We had one in Squaw Valley, and we even got into Oakland, California, where we put on these conferences for a day, and a couple of hundred entrepreneurs would show up to hear from lawyers, accountants, and financial people how to access capital from venture capital industry. And that's why we called it Access Capital. So I became the chairman of that, and it grew, and it did really well. And it really, quite frankly, changed the dynamics of the platform up there in California, outside the Silicon Valley area. And we actually put on a conference at UC Davis that was spawned by Stanford, the head of Stanford's technology licensing division, and I came to the idea of putting on a conference in Sacramento to promote the technology that Stanford was developing that didn't pencil out in the Valley because the costs of the Valley are so high. Yeah. And we had it at UC Davis. A couple of hundred people showed up for talks about from the universities. We ended up having UC Davis, UC Berkeley, Lawrence Livermore Labs, and Stanford all on the same stage talking about how they wanted to bring that technology that the public had financed and bring it into the market to create businesses. And that was in 1998. So that was kind of my start. And then I went on and did similar things in Manhattan with Deloitte & Touche as a partner. I wasn't an employee. I was partnered with Deloitte & Touche, and we put on what I called Venture Link in 2003 to 2005. And that was showcasing venture capital funds in raise in coordination with research institutions to bring that technology to market. And that was kind of pioneering. Nobody had ever done that. And here I was, a life insurance agent. Basically, that's how I got into business. I started as a estate planner, which is a life insurance ploy. And there I was putting on these conferences in Manhattan. It was kind of cool, way over my head. Yeah. Way over my head. You know, I had a degree in plant science from Utah State University, and everybody around me was Stanford or MBAs or more. In fact, all my associates were PhDs. They had law degrees. And my partner at Deloitte, it took 6 months after I met him, I found out that he had a law degree from Wharton. And we were buddies. He was my best friend. And it was interesting. I didn't know anything about his background, but I gravitated towards that venture capital arena. And then I started realizing how much damage the big corporations and the big banking structure was doing to our country. So by 2007, I left the industry. Yeah. And when crowdfunding came along in 2012, I really gravitated towards it, educated myself, but it didn't get implemented in a way that was effective for businesses until 2021, when the regulations came out that enabled businesses to raise up to $5 million. And initially, it was only $1 million. Yeah. And now they could raise up to $5 million.
And what are, so thinking about the last, 4 or 5 years, you've certainly had a front row seat to analyzing and reviewing a lot of the campaigns that have done well, and I'm sure even participated in some of the better deals. But what do you see right now that separates there are so many opportunities for the different type of SPVs that are out there. You mentioned some offline, we were talking about bonds versus equity versus other safe notes. Where do you see, the successful raises come from? Not necessarily industry, but is there any common linkage between them that you see that their success?
Well, I think it's important to focus on the equity versus bonds if you're a business. If you're a small business, I'm going to use a restaurant idea as an example. You're building a restaurant. By the way, over the weekend, I work at a restaurant in the back of the house at a restaurant, a barbecue place. Give myself some something to do and a place to meet friends and stuff like that. But so I really have the restaurant interest. But if you're a restaurant and you're successful and you're looking to open another branch, another location, or redo your kitchen or whatever, you need $100,000, $250,000 to expand your business. Well, banks are not suited to that. The bank loans are not suited to that because that's a risk, and banks are not in the risk business. Commercial banks are not in the risk business. They're in the financing of cash flow business. Yeah. So they will, the commercial banker's favorite word is no. So that's not suited. And then to sell, to go to the private investment community, well, those private investments come in with a lot of strings. And those strings are really going to transfer the value of what you're creating from you and your family to the private investors. So that's why I call them vulture capitalists. And so here you are, a restaurant looking to do that. Now, if you sell equity, how does the investor get their money out? That's the big challenge. If you're selling equity, the investor, first off, wants a bigger return because there's a larger risk, there's a larger holding period. And then how do you get your money out? Generally, you have to either sell the company or go public, or how are the investors going to get paid off at the fair value of the company? Well, you don't know what the fair value of the company is because it's not in the public market, so it's not being traded. So you have to sell it in order to put it out there and say, here's what we got, how much you want to pay. That's the nature of how our economy works. So selling equity, and originally all this was called equity crowdfunding, which is not the right name, because you can sell any type of security through crowdfunding.
Yep.
So you can sell bonds, and bonds can be very flexible in their design. And unlike bank loans, they don't require you to put up your house as collateral.
Yeah.
It's all based on the full faith and credit of the company. Now, one of the things I'd like to do at this point is say, I am not a lawyer, and I am not offering investment advice. I'm providing this information solely for educational purposes, and I could be wrong on some of it. I'm wrong generally once or twice a week. I know that this stuff, but anybody listening has to understand, I'm not giving you advice. Right. I'm giving you a foundation of education, hopefully that you can talk to the lawyers better with, because if you can't talk to the lawyers better, they're going to run up the bill. So if you know enough on the front end, it'll be cheaper yep. discussion. And you might not.
Here are your deal points, right?
Yeah. So that's really what drew me to it, was this just fundamental interest in small business, free market capitalism, and getting away from these huge corporations that control our lives.
So do you think one versus another is a better starting point for a deal? Or do you see, you mentioned the restaurant as the example, and when you're talking about a community round here where they're going out to their community, a restaurant's community by and large is going to be maybe more regionally focused, even though it could be a national platform, right? Versus a technology that has wider ranging implications or uses.
Well, yeah. So if you're a technology company and you're looking to sell equity, you have in something that has, as you say, wider ranging potential and growth potential, then you would be issuing stocks. You might issue convertible bonds. That's a common approach. You issue convertible bonds, but they can become equity. Whereas if you're a restaurant, if you sell equity, you've got the challenge of how do you pay off your investors. Whereas if you sell bonds, you might issue, let's say you issue a 3-year bond at 10% interest. Well, now that's a pretty good interest rate compared to the bank. And you can sell many of the platforms you mentioned in our offline discussion, WeFunder, and your relationship with WeFunder. They're really focused on the masses. And I'm not sure exactly what their minimum is, but many companies are down to $100. So a person could invest $100 and earn 10% interest on it. Now that's not a whole lot of money but it's right. A lot less risk, and it gives you a chance to get a feeling for how it works. And you're not having to go to a CD to get 5% interest and lock it up for 3 years and $5,000 minimum.
Right.
So it's a better entree for the retail investor, the regular non-accredited investor. It's a better entree into the market, and the ability to not have to put up your home for you got a family, and you put and a business, you put up your home, your business goes south and you lose everything.
Yeah.
Did you want the business to go south? No. But do you want to lose your home and be homeless? I mean, that's not a good choice to me. I don't like that part of the banking structure.
Yeah.
Or the SBA, because they really push that if the SBA is going to back the loan, they want to see a house behind it. And they also, anyway, I don't want to go into too much detail. So that arena offers the ability of that restaurant to raise $50, $100, $150,000 through issuing 3, 4, or 5-year bond terms, and those terms can be really interesting because they can be revenue participation bonds. Mm-hmm. Have you heard much about that?
Yeah,
you've heard about it, but have the masses heard about it? It's very interesting because now the bond is only going to pay when you have revenue. So it's not like, tying you down to a bank loan. It gives you the ability to build the business and afford the payments.
Yeah.
So that's one of the sweet parts of it. But bonds can be designed in a lot of different ways. Of course, whatever type of design change you want is going to involve one of those lawyers, and they're not cheap.
Yeah.
So, but that's what I think is a really powerful opportunity that's oftentimes just overlooked because nobody's promulgating it. There's not a whole lot. There's a lot more in that technology financing arena where somebody might make 10x on their money. That's, what they want to make 10 times their investment. It's a lot more risk, but boy, so that's the venture capital approach. Well, most private equity most private businesses are not suited to that. They don't want to be suited to that. They're building a lifestyle.
So thinking about campaigns that are successful, not just are there the options of how to bring a deal to the masses or to their community or, to other retail investors. What do you
Well, the most important thing that a business owner needs to do in order to prepare for potentially this route of investing is to build their network of connections.
Well, that's what I was going to get to, thinking about that, what the element of like building a community beforehand and getting people, interested in whatever your mission is, and then aligning a mission with your business so that, there is it's an opportunity to have more personal connection to your investors versus, you mentioned, previously, these private equity groups or these, family investment firms that are only looking at a hockey stick sort of projection.
Yeah. That connection with the community is so vital, and the community can be geographic or interest, so the community, so the people with the same interests are in a community, the people in the same region are in a community. You build that relationship with the community in advance because the non-accredited investors don't understand private equity investing because we've been restricted from it since the 30s, since the Great Depression. Yeah. And there's been an active effort to say, oh, no, that's over your head. I mean, basically, the government was saying we're a nanny state, and that's too risky for you poor people, you non-millionaires. That's the essence of what they're saying. So that's going to be just for us rich people. And the rest of you invest in the public markets after we've gotten all the real value out of the company building it. And that's really screwed private market people, the non-accredited investor community, which is the vast amount of people in the country. So you got to educate them a little bit. You have to help them understand that this is a new opportunity, that basically, because the 2016 regulations were so onerous and restrictive, I don't even count that as a part of the play time. That was kind of like in bowling, you get a couple of free frames before you're starting to get charged, right? The same thing, that was kind of like not really part of it. So it's only 2021 and it was March. So what, we're coming up on 5 years ago?
Yeah.
That's pretty recent. And there's not the bankers, the big corporation, the venture capitalists, they don't want, well, they're turning around. Okay, the venture capitalists.
Are you seeing that? Are you seeing that I've said this a number of times in a couple of different places, is that crowdfunding is now becoming that spot where they validate their deals beforehand, or they
absolutely validate.
Yeah. Are you seeing that too?
Absolutely, you're right. Yeah, it's that not only validate, they it's kind of a part of a due diligence. If you're a business that can't raise money from the masses, are you really that good of a business? It's kind of like that the crowd, the wisdom of the crowd. The wisdom of the crowd is very prominent, and it's recognized. That's where the bond community works so well. It's the wisdom of the crowd. It doesn't matter what the Fed says the interest rates are. The bond market's going to make the determination because of the market.
Yep.
If you can't get people to invest at that interest rate, then that's not going to be the interest rate. It's going to be higher. And so that provides kind of a due diligence step for it. But you have to build that relationship, and doing it through an email newsletter approach. And you don't have to send as a small business, you don't have to send a newsletter out every week or every month or every quarter. You don't have to send it out at all. But what you do want to have is the permission of people to send it, because otherwise you're breaking the law. You can't send an unsolicited mass email to people.
Right.
They have to give you permission. So you want to build that. And when you're building it, you might want to share some stuff about your business. This is what we're doing. This is how we're growing.
The progress.
We're looking at the future. We're considering this market, and thanks for, your patronage, and we're growing, and it's thanks to you. That's just regular business. You're reminding the people that you're out there, but you also then can take another step and start educating them.
Yeah.
And you can start before you launch a campaign, you can test the waters.
So, let's talk a little bit about your newsletter, because you've done a really good job of helping educate your community on the opportunities in crowdfunding and the different areas of opportunity, whether it be Reg CF, A+, or even, as you mentioned earlier, some of the tokenization of the economy that is out there. So, and it's kind of a neat story. You told me a little bit about it, but let's start with the shack in your newsletter and how that came to be.
So I lived on a ranch in Bend, Oregon, and it was COVID, and we didn't have to wear a mask because we lived on a 18-acre ranch, and there were no neighbors. And I just rented the old part of the old barn, the shed. But sheds at barns are huge. It was 25-foot tall shed.
Yeah.
And I came across an old 1999 Ford F550. I didn't know there were F550s. And it was a 16-foot flatbed. And it was at a price that I thought was great. It was from a fleet that was really well managed. And I bought it. And I built a shack or a building on top of it. And 3/4 of it is the building. It's all covered under a roof. And then the very back end is a area for a stage. So my goal and one of my projects is to start a business where I'm working at farmers markets and farm sales and harvest markets and things like that, and bringing my truck. bailed it out. People don't understand that we did a horrible thing in bailing out Silicon Valley Bank, because we just took all the people, and ultimately the cost comes down to us, and we bailed out the big banks, and they shouldn't have been bailed out. And they shouldn't have had all the money, because the principle of investing is diversification, and crowdfunding gives you a lot of opportunity to diversify.
Yeah.
If you want to invest $10,000 into a private company, I would recommend find 5 private companies, because one or 2 or 3 of them may fail. That's the principle of venture capital, right?
Absolutely.
Diversify, spread your eggs into multiple baskets. So am I following what you asked? I get off on tangents.
Yeah, I mean, and that's what you can find for content in your newsletter. How can people opt in and actually subscribe?
Okay, so it's on Substack. Well, I'm hoping you'll put a link in the.
Yeah, well, yep, we will.
So there we can subscribe there. I don't charge a fee. Okay. And Substack has both subscribers and followers, and I have free subscribers. I don't charge a fee, but as I get deeper and deeper into details, I am going to offer a fee-based version, where that might be $10 a month. But that'll be for people that really want to dig deep into these issues. But otherwise, when you go to subscribe, just hit the free button. Substack, the company, wants people to pay. So they, even if there is no pay option, they're still offering it, even though it's not there. So just go with the free version.
Yeah.
And I have 4 different accounts, so you can find all 4 on there. So it's I'm gonna switch over here, because I think I mentioned I'm almost 70 years old, and I have short-term memory issues. But I've always had short-term memory issues. I just use the age as an excuse now. So it's called the Shack Media Hub. There's another one called the Heritage Project, which is the heritage is free market independent businesses. That's the heritage I'm really promoting in that statement. That's what America was built on, was independent, free businesses, which is something the rest of the world didn't have when George Washington helped us build this company, and he was the United States' first entrepreneur. And a farmer too. I mentioned I like farming. And then there's another one called Funding Films, NFTs, Royalty Sharing. So NFTs are non-fungible tokens, royalty sharing, and crowdfunding. So that's another name, subject to change. That name's subject to change. And then there's another one called Dream Acres, which is actually, I'm trying to build a new concept of business incubator. You probably work with a lot of business incubation companies. You mentioned some of your clients. Some of them, I believe, went through possibly even Y Combinator, one of the most prestigious
We've been really
incubators.
fortunate. We have a number of clients that are gone through various ways of coming out the other side. So we're familiar with that. And
So business incubators are mainly focused on high-tech companies to support that venture capital arena. I want to take it the opposite way, and I want to create food truck parks to promote small food trucks, which is a great way for chefs and restaurateurs to get into a business. For $50,000, $30,000, you can do a food truck, as opposed to signing a 5-year lease, and how do you come up with $250,000 to start a restaurant?
Right.
And the food truck parks are based on what I learned over in Oregon. What they did is they put in city water and city sewer, so they hook up just like RVs, and they're year round. So they're excellent community centers, and they are by nature inspiring people the food truck or
Yeah.
the park itself, because owning the park, that's real estate. And you're not building buildings. When you want to develop the real estate, you simply roll away the trucks and you have all the underground work done. So it's, I think, an incredible opportunity. I'm over here in Boise now. They don't have any. The first one that went into place in the Bend area was, and Bend is in Deschutes County, Oregon.
Yeah.
So there's 5 cities: Sisters, a great city; Bend, a good city; Redmond, um, 2 others. Anyway, the first food truck park authorized by the health department went into place in 2013. There are 38 of them now in the county.
Yeah.
So that is a market telling you that they work.
Yeah.
So here in Boise, they have none. So that's one of the things I'd like to do. But I want to add the idea of artisan retail as well, to get the artists and the people making product that you're not going to find at Walmart.
Right.
And promote that artisan retail, farmers market type of year-round process, with the food trucks being the foundation. So that's called Dream Acres.
Man, you are a busy guy. It is. I'm so thankful to, have had you, answer my note, being part of your community as well, and hear you today, talking about all these different.
Well, thanks. I'm busy, but I'm retired, and I don't like to golf, and I'm not big on fishing.
There
So
you go.
I like to build things, and I'm 68. I said 70. I'm 68. So the president of the United States is 78. So I figure I got a few years. If I make it half the way. So that's kind of.
You got enough missions to keep you busy. So,
But they're all interrelated.
and we'll link to them all here on the show, and maybe have to have you come back to go into some more. So, man, CJ, it's been great having you on today. I really appreciate the opportunity to get to know you a little bit better and share your insight.
It's great to be on, and you're the second podcast that I've been invited to be on. So thank you.
All right. Well, hopefully leads you to more then.
Yeah.
Yeah.
So.
All right. Well, thank you very much. On behalf of my guest today, CJ Connell, the editor of the Shack Media Hub, amongst several other projects. We really appreciate him coming on, and thank you for listening and watching the Tagline Podcast. Until next time.
I grew up in New Jersey, and we talk fast there, and I have a New Jersey accent, even though it's been decades. So I hope I stayed on track enough